signaling hypothesis, right, to support its theory, to say that basically, yes, no doubt that dividends policy send a positive signal to the investors, but then this signal will only cause the investors to adjust or to revise the earning forecasts. Okay, so in other words, it's saying that it's nothing to do with the risk. It doesn't affect the risk. It doesn't affect the cost of capital or required rate of return. It's just that it sends a signal when company has the dividend policy. It sends a positive signal to investor. Investor revise their earning forecasts upward. That's all. Okay, so it doesn't affect the risk, right? Then in order to counter this argument, so we can actually use EMH, right? EMH to counter argue that dividend increases are built into expectation, and dividend announcement could lower stock price as well as raise it, depending on how well the dividend increase matches the expectation. So therefore, a bias towards price increase with dividend increase support GL. So this is using EMH to counter argue back to the MM. Then after that, similar questions, but this time using clientele effects. So in other words, this question, right, you just have to know what is this theory, okay? Then the clientele effects. So the clientele effect basically is telling us that dividend policy is subjective. Whether investor like it or not, it's very subjective. It all depends on the types of investors. Some investors prefer dividends. Other investors prefer capital gain or growth. So therefore, a company with dividend policy and company without dividend policy, they are as good as each other. Okay, we cannot say that company with dividend policy is better than company without dividend policy. It's a matter of preference, depending on the clientele. The client here is referring to investors. Okay, different types of investors. Right. Okay, so but then clientele or investors, some are rich, some are not so rich, so they are of different sizes. Therefore, in this argument, you say that dividend policy, it does matter, because you will see that those companies with dividend policies tend to attract more wealthy investors, okay, as compared to company without dividend policy. So that's the counter argument. All right, so this question, I would say, is important for you to know the theories on dividends policy. Okay. All right, number 5. Okay, number 5, executive salary has been shown to be more closely correlated to the size of the firm than its profitability. So if a firm board of directors is controlled by management rather than outside director, this might result in firm retain more earning than can be justified from the stockholders' point of view. Discuss this statement. A. Discuss the interrelation among cost of capital, investment opportunity, and new investment. Based on this fact, based on these points, and you discuss this relationship. Okay, all right. Now, this is very true. This sentence basically is based on the reality. Okay, what happened in the reality? That a lot of time, if you look at the CEO salary, it all depends on the size of the firm. Okay, the larger the company, you tend to find that the CEO salary is bigger. Okay, so that is a fact. Instead of the CEO salary should be tied together with the profitability, right? It makes more sense, isn't it? How much the CEO salary should be based on how much it helps the companies to make money, right? But in actual fact, it is not. It's just based on the size of the company. So in other words, imagine that if you are the CEO of a company, you know that your salary is tied with the size of the company. So what would you do? Of course, you would spend money on expanding business to make it larger so that you can get fatter, bigger salary, right? Okay. So at the end, what happened to this relationship? So basically, what happened is that you will keep investing, keep expanding the business to the extent that you don't really care about whether the new project can make good profit or not. You just keep investing. Okay, make the firm become larger so that you earn more. So there's a conflict of interest, like in other words. Okay, so I think the reading part I leave it to you, lah. Okay, but I just roughly explain to you what this question is about. So yeah, so the CEO may actually invest in project that the return is actually lower than the cost of capital to that extent, right? Which is of course not good for the shareholders. Okay, then after that, it said explain the implied relationship between dividend policy and stock price. So the implied relationship. So if the firm invests to a point where the return on investment is less than the cost of capital, the stock price must fall below what it otherwise would have been. Stockholder will be given additional benefit from higher return earning, and this might well push up the stock price. But the increase in stock price will be less than the value of dividend for sure if the company had paid out larger percentage of its earning. Okay, so in other words, since the company retain more earning, so there is showing growth, there is a growth being shown, being demonstrated. Therefore, it may actually help to push up the stock price because investor will see that there's growth. However, the growth in the stock price will be less than if the company would have used the money and distribute out to investor, shareholder in the form of dividends. Okay, so in other words, it's about firm value lah. Okay, it's about firm value. So, all right, then after that, number 6. Okay, number 6 is on no longer on dividend policy. So it's on the different types of rewards, stock dividends and stock splits. Okay. Now, basically, when we talk about dividends, right, by default, it's referring to cash dividend. Okay. So in this case, it's asked about stock dividends and stock splits. What is the difference? Which one would you prefer? Okay. All right. So what's the difference? The difference actually is just in terms of accounting treatments. All right. In terms of accounting treatment, the total value is still the same one, no different one. So in the case of splits, the firm simply increase the number of shares and simultaneously reduce the par value. So in the case of stock dividend, they must be transferred from retained earning to capital stock. So this part here basically is telling you about the accounting treatment will be different. That's all. Okay. Other than that, it's no different one. All right. Regardless of which one you choose, your total value of your stock is still remain the same. It's a matter of preference line, in other words. Now, when we talk about the stock splits, I like to give this typical example, which is Public Bank. All right, Public Bank had done many rounds of stock splits to the extent that if somebody who have subscribed to the IPO, one lot, 1,000 many years ago, 1,000 shares, that 1,000 share now would have become a few 100,000 shares already because of stock splits. Okay. Now, the main idea behind stock split is to keep the price affordable for many investors to continue to support, to invest. Okay, when the price go up, then the company will do stock splits to bring down the price to become lower and the share multiply. That's what happened. And that's what happened to Public Bank. Okay. And that's why until today, Public Bank share price is still actually quite low, despite the fact that its performance is very good consistently every year. Okay. There's a calculation that somebody who bought one lot, which is equivalent to 1,000 share in the old time, now one lot is equals to 100 share. That 1,000 share may actually cost somebody probably 1,000 plus ringgit at that time. But now that 1,000 plus the cost of owning one lot is worth 3 million plus. Okay, can you imagine that? Okay, it costs somebody to buy the share one lot 1,000 plus. You don't have to do anything, just leave it. Okay, now it's worth 3 million something. Can you imagine that? And how much is the return? All right, now let's move on to question number 7. Okay, you read the question first. I run to the toilet break. Okay, let's have 2 minutes, 1 minute toilet break. At least you read the question first. Okay, all right. Okay, question number 7. Okay, so here he said that Excel Telecommunication has a target capital structure consists of 70% debt, 30% equity. So this is what we call as the capital structure, right? So the company anticipates that its capital budget for the upcoming year will be 3 million. So if the company report net income of 2 million and you follow a residual dividend payout policy, what will be its dividend payout ratio? So that's the questions. Okay, so as I mentioned just now, when it comes to dividend policy, um, there's a few dividend policy that a company can adopt, and this is definitely one of them. And this one actually is very popular. Okay, residual dividend payout policy is very popular among many companies. By the way, when it comes to Malaysian companies, right? Most of the Malaysian companies don't have dividend policy. Okay, they don't have because Malaysian companies are too small. Okay, they don't dare to commit themselves. And another reason is that uh, in Malaysia, most of the investors, I don't think they really appreciate dividend policy. Because, in other words, most of the investors in Malaysia, right, they are more looking forwards to capital gain instead of dividends. Okay, so therefore, it's not worth it for companies to have dividend policy. But in the US, of course, it's very common for some of these companies to have dividend policy. Okay. So anyway, now this residual dividend payout policy is in this policy basically it said that the company will only pay out the dividends after the company use its earning for uh, other things. Okay, for example, if the company need the money to for further investment or expansion, the company will use the earning to do those things first. Whatever is remaining residual, only then this amount of money will be paid out as dividends. So therefore, it's not that bad. Okay, the commitment is less. Okay, as compared to you have some dividend policies that okay they fix how much to pay every year and what is the growth rates every year. So those are very aggressive one. Okay, otherwise residual is quite okay. Okay, all right. So question is asking for dividend payout ratio. All right. Okay. Now this question, right? Basically, where you start is you start with this 3 million. In other words, think about the company need 3 million. Okay, capital budgeting is 3 million. The company, company want to spend this $3 million. The next question is where the money come from. Okay, where the money come from. So based on the capital structure, it said that 70% will be financed by debt. 70% of 3 million will be financed by debt. 30% of this 3 million will be financed by common equity. Okay, so in other words, you draw. Okay, this one I don't draw. Okay, anyway, you can draw like this. You can draw here you draw 3 million. 3 million budget. You can write okay, you write yourself. 3 million budget, capital budgeting, capital budget. This 3 million will split into debts and equity. Okay, that is 70%, right? That's 70%. So 70% times 3 million is 2.1 million. Okay, then which means equity is 30%. 30% is 0.9 million. Okay. All right. Then the question say the company make 2 million. Remember that just now I mentioned that this return earning, this earning, right, 2 million is considered as internal equity right here, the E. Okay, 2 million. Okay, so 2 million, the company need to spend 0.9 million. So 2 million minus 9 million, 9 million. So the company will have earning remaining 1.1 million. Okay, company make 2 million, 900,000 need to spend. So the remaining is 1.1 million. So this remaining 1.1 million will be paid out as dividends. All right, to get the dividends payout ratio, you use the 1.1 divided by the net income. So the dividend payout is 55%. Okay, so I would say if you know how to draw this diagram, it will be much easier for your understanding. Okay, number 8. Stock splits. 3 for 2 stock splits. Now, what does that mean by 3 for 2 stock splits? 3 for 2 means currently your 2 share after the split will become 3 shares. For every 2 share that you own, after the split, it become 3 shares. Okay. All right. So what will be the company stock price? Now, what do you think? Now, first of all, before you do any calculation, let me ask you this. Do you think the stock price will be higher or lower than $90, the current price before the split? Yeah, lower, right? Lower. Because at the end, you calculate is still the same one. The total value will still remain the same one. So that's an important point for you to know. Okay, so the stock price after the split will be lower. Okay. All right. So how do you calculate this? You use the $90 divided by 3/2. So the answer is 60. Now you can double check. You can double check because, like I said, the total value should be remain the same. Okay, before and after the split. So you can check, you can calculate $90 times 2, $90 times 2 share equals to 180, right? $60 times 3 shares equals to 180 as well. So that's how you double check. Okay. All right. Number 9. Number 9, Beta Industry has net income of 2 million. It has 1 million share of common stock outstanding. The company stock currently trade at $32 per share. The company considering a plan in which it will use available cash to purchase 20% of its share in the open market. So this question is about share buyback. Share buyback or share repurchase. Okay, share buyback or share repurchase. Now, what is the idea behind share buyback? When company share buyback is on share, basically it will reduce the outstanding number of shares. When the outstanding number of shares reduce, earning per share increase, right? Earning per share increase. Okay, so if earning per share increase, when the P ratio remain the same, therefore the price must increase because earning per share increase, P must increase so that P ratio remain the same. So that's the whole idea behind share repurchase. That's why share repurchase is considered as a form of rewards to investors. In other words, it's good news to investors. Okay, so what will be the beta stock price following the stock repurchase? Yeah, so basically you will see the calculation is exactly what I just said. All right. So first thing from the information given, the first thing is you want to calculate for the earning per share. Earning per share is not given. So like I said, the whole idea is about earning per share, increasing earning per share. So that's the whole idea. So therefore, you must know the earning per share. If it's given, then you just take. If it's not given, definitely you need to calculate. Right. So it's not given here. So therefore, you need to calculate. So we calculate the earning per share before the share buyback, which is net income divided by number of share. That's $2. All right. Then after that, I did mention just now about P/E ratio. Assuming the P/E ratio remain the same, okay, so we need to calculate or we need to know what is the P/E ratio. All right, P/E ratio is $32 current price divided by $2, which is the earning per share. So give us 16 times. Now, assuming that P/E ratio is still the same, so now before that, we want to calculate the new earning per share after the share buyback. So what happened after the share buyback is the outstanding number of shares has reduced from 1 million to 800,000 shares. Therefore, the earning per share now become higher. From $2 now increased to $2.50. Okay, assuming the P ratio remain at 16 times, so now we can find a new price. So the new price now is or should be $40. Should be $40. Okay, from $32 after the share buyback, it is estimated the stock price should be trading at $40. Okay, so that's how it works. Okay, all right. Then now we move on to the last questions for the day. Okay, Northern Pacific Heating and Cooling Incorporation has 6-month backlog of order for its patent patented solar heating system. To meet this demand, management plan to expand production capacity by 40% with a 10 million investment in plants and machinery. Okay, 10 million. Remember, the focus will be 10 million. This is how much the company want to spend. And the next question is, where does the money come from? Capital structure. How much come from debt? How much come from equity? Okay, so the firm want to maintain 40% debt. All right. You also want to maintain its past dividend policy of 45%. Okay, so in 2008, net income was 5 million. How much external equity must the company seek at the beginning of 2009? So the question is asking, how much is the external equity? Okay, so again, it's easier if you draw the time, not timeline, sorry, the diagram. Like I say, start with the expenditure. Okay, the capital expenditure in this case is 10 million. The budget, right? Budget, expenditure, capital expenditure or capital budget is the same thing, 10 million. And the question said 40% debt ratio. So 4 million, the 10 million, 4 million will be financed by using debt. 6 million will be financed by using equity. And equity can be divided into external and internal. All right. So internal, how do we figure out 2.75 million? Is that using the net income times 1 minus payout ratio. 1 minus payout ratio equals to retention ratio. Okay, 5 million income, how much is being retained? And that retained earning is considered as an internal equity. Okay, internal equity, how much is being retained? How much earning is being retained? And that's internal equity. So we got 2.75 million. All right, 2.75 million. So 6 minus 2.75, that means the new external equity needed is 3.25 million. Okay, so which means the company now need to raise 3.25 million using external equity. In other words, issue new share worth 3.25 million. Okay, so I hope by sharing this diagram will help you to easier to understand. Okay, so I guess that's all. With that, that's all for today's tutorial. Any questions? Now, for your midterm, one of the questions. Oh, by the way, after when because I didn't have the access to the question paper beforehand before the midterm. So when I was marking, I look at the question. Many of those questions are actually past year final exam questions, if I'm not mistaken. At least a few. At least a few questions actually Mr. Pua recycled from past year final exam questions. Okay, and there was one question, part A. What question was there? That's ask you how many share can you buy? Yeah. Ask you how many share can you buy. Is it question 2 or 3? I forgot already. Question 2 or 3. Ask you how many share can you buy. Some of you answer using leverage, using leverage lah. Okay, using margin account. But the correct answer is actually using cash accounts. Okay. So how I mark was that, but some of you very smart. Some of you very good. You provide both. That means with leverage, with a margin account, 1,800 plus 11817 or something share you can buy. With cash account, 2,000 share. So by right, I'm supposed to deduct lah if I follow strictly the marking scheme. if you do give me two answers, of course, by right supposed to deduct mark. But then I didn't deduct mark. I only deduct mark if you only provide answer based on margin accounts. Because unfortunately, the answer given is based on cash account. Yes, no doubt, the question didn't mention anything. So it can be interpreted as trading on cash account or margin accounts. Okay. So for those of you who provide both, I give full mark, 3 marks. In other words, you provide cash account 2,000, also full mark. But if you only provide answer for based on margin account 1817, then I need to deduct 1 mark. I mean, I deducted 1 mark, which is two lah. You get 2 out of 3. Okay, all right. Anyway, quite many of you managed to score 80 plus and above, which is good. Okay, so I will discuss with you guys more about. I'll go through with you guys the midterm. Okay, on the 13 and 16. Okay, so if there's no further questions, you can go. You can leave now. Okay, so I'll talk to you. I'll see you guys on 13, either 13 or 16. Have a good night. But if you have question to ask, then you stay back.